So hi friends, so we are back on accounting again today, and we are going to cover today the third aspect of accounting, that is our cash flow. Cash flow is the heart and soul of every company. The profit and loss statement typically gives us the sales which the company has made, but not what the company has earned in terms of cash. There are certain accounting rules which the company follows, and as per the accounting rules, say suppose the company has manufactured a certain good and has delivered to its customer, but the customer might not have paid for that particular good. The customer might issue a promissory note, verbal promissory note. So because this transaction, as per the accounting rules, result into a sale, even though it has not received cash, but it has delivered the product. Cash flow hence becomes the major aspect to determine whether the company is truly having cash, though it declares that it has profits. So the cash flow has three aspects. Now when we are going to understand cash flow, when we see that cash flow statement typically, it usually starts from cash flow from operating activities, then it goes over to cash flow from investing activities, and third it goes over to cash flow from financing activities. But however, for the study purpose, for us to interpret and understand cash flow statement, we will look at it from the opposite side. First we'll understand financing activities, and then we'll understand investing, and then operating activities. I will explain why we need to do it in the reverse order in order to understand cash flow. See, when we typically start a company, we need capital, we need financing. So hence the cash flow from financing activities comes first in our understanding. So who will finance? The financing comes from public to the IPO process. It comes from the promoters from his own capital, whatever he might want to invest. It comes from the banks and institutions through loans. So these are all parts of the financing activity. Now, because it has raised certain loans, right, it will have to pay interest on those loans. Now, whatever incoming is there as part of the financing activity and whatever outflow as a result of that financing activity is also mentioned as part of the cash flow from financing activity. So now let us say, the company promoters have invested capital which is reflected into financing activities. The IPO, after the IPO, that finance also is reflected into the financing activity. Now the dividends paid out by the company because of these investments by the promoters and the shareholders, these are causing outflow in the financing activity itself. So these are also mentioned as part of the financing portion. Now the second part, that is the investing activities. So once the company has secured its finances, now it is ready to buy assets, right, so that it can start operations. So now the asset part is basically what the company invests this raised capital. It has the raised capital. Now depending on how much raised capital it has, it goes and invests into properties, it goes and invests into manufacturing units, it goes and invests into trademarks, copyrights, it goes and invests into certain marketable securities if it has probably excess of financing for itself. So all these aspects wherein the company invests into properties, that is tangible asset, and invests into intangible assets, that is in terms of trademark, copyrights. So these are part of the cash flow from investing activities. Now whatever the company earns in terms of rent, suppose it might have raised assets, but after raising asset it might have given certain assets on rent to somebody. So the income of cash resulted out of giving a property on rent or on lease, that income also is mentioned as part of the investing activity. It might have made investing into marketable securities or shares for earning dividends or interest. Those are also mentioned as part of inflows into the investing activity. Now whenever cash comes in, it is positive. Whenever cash goes out in a particular cash flow, that is a negative sign. Negative sign in the sense it is represented as a negative value. So now that we have understood what is investing activities, finally the company is ready to start its operation. Hence, anything else falling out of financing and investing activities which are directly catering to the direct manufacturing of the products and things like that, those are all part of the operating activities. So cash flow from operating activities is a direct reflection of the profit and loss statement. Now the way cash flow from operating activities is represented, there are two methods. One is the direct method and the indirect method. So most of the companies usually nowadays they follow the indirect method because that is a more convenient way of following the or capturing the cash flow from operating activities. So usually they start with the net profit and then they mention all the adjustments with respect to the non-cash expenses which it has. So we'll understand every aspect of detail which goes into the operating cash flow when we look into an illustration of a particular company. So as of now, it is required for us to understand that cash flow from operating activity is typically what goes into is P&L, right? So basically what the company earns as revenue and what the company spends or incurs as expenses towards manufacturing of the goods. So depreciation and amortization, which is an expense, this is also non-cash expense. So whenever it comes to indirect method of cash flow of operating expenses, these non-cash expenses are basically what is adjusted. So we have finally understood balance sheet, we have understood profit and loss statement much earlier, and then finally today cash flow statement. So going further, we'll look into the profitability ratios, which can be measured as part of the P&L, balance sheet and cash flow as well, and look at the illustration as well going forward. See you then. Bye.